Hello, and welcome to the LA Venture Podcast. This is Minnie Ingersoll, host of the podcast and partner at 10110. 10110 is a seed stage fund here in LA. All opinions expressed on this show by me and my guests are solely our own. Arjan Schütte is the founder and managing partner of Core Innovation Capital. Core invests in financial services companies that empower everyday Americans. Core is making seed and pre-seed investments out of its $125 million third fund. They have a great portfolio of companies like Ripple, Synapse, Opportune, NerdWallet, and more. Arjan, welcome to the podcast.
Great to be with you.
Great. I heard you say that you are, your mission is something like to democratize prosperity. I really like that.
Me too.
How's that working for us?
Well, if it wasn't obvious that we needed it before COVID, it certainly is obvious today. And how's it going? Well, mixed, honestly. You know, we're a small fund and there's lots of people doing similar work, and it's a big, gnarly, complicated problem that needs more investments and is getting more investments, but can't only be investments. There needs to be a policy side to it as well, which on the side of my desk I'm trying to figure out how to do. Separate story, but there are so many ways in which the private sector can figure out this set of public sector problems. And it's just fun to see, you know, the emergence of mission-driven fintechs of so many shapes and flavors out there chipping away at this.
Yeah, what are the big levers, or where are you focused?
So we really started looking at the un- and underbanked, where we perceived there to be a boatload of people, shockingly so. I had no idea how many people were un- and underbanked. And then B, a complete absence of technology, right? Like it's kind of a old school world of like, you know, place-based check cashers and such that serve that industry at like significant scale. Consumers are spending like $100 billion on stuff that you and I get entirely for free.
Where does that come from?
Yeah, it's fees. So I want to cash this check. Oh, that'll cost you, you know, 1 to 10% of the face value of that check for me to assume that you didn't Photoshop it. And give you cash in return, or it's fees on payday loans, or on title leases, or on, you know, a whole litany, or on Western Union checks, right? Or even just paying your bills. You know, like a shocking number of people walk into a physical location, say a 7-Eleven, to pay their bills, right? Like we do this for free. I get miles for paying my bills, right? Like I'm actually making money paying my bills.
They walk into the 7-Eleven. I actually don't really know the experience there, having not had to do it myself. And 7-Eleven charges them fees to pay their bills.
Yeah, so you walk in with your Comcast, you know, paper receipt, and you say, "I want to pay this," and they say, "Great." You know, how long do you want to take to, you know, if typically like if you want to wait, you know, a week, it's free or cheap, and if you need it expedited today. And that's typically, you know, how long you've waited because you've got kids and you're hanging out to your cash, you know, as long as possible to wait for, you know, what you need it for. And then when you come at the 11th hour and you want it to clear today, it'll cost you up to $20 per bill just to have it expedited in real time so that your power doesn't go out.
So are you looking at, you know, solutions to eliminating those fees? How do you approach that?
Yeah. So by shifting from a cash-based economy to a digital economy, you can eliminate a lot of this stuff. And so that starts at the payroll, right? Because how people end up with cash in their hand is because they get a pay check and then they take that to a check casher and then they sort that out, right? They put some in their pocket, you use some to pay your bills, you pay your rent, you send some home, you know, wherever your home is. And, you know, and that's kind of how you conduct your whole financial life there. And it's very fee extractive. If you can get direct deposit, which is a very positive trend that has grown in the last, you know, like 20 years, where direct deposits started with something like 8% of the population, and now it's something like 93% of the population. Very positive trend. And so then you can do a lot of these things digitally or more or less digitally, and you can chip away at all the middlemen basically who've got their hand in the middle of the transaction.
Play this out for me a couple years.
Sadly, it'll look pretty similar for a couple years yet, because our infrastructure lags dramatically. So, for example, we're like the only modern economy that doesn't have a real-time Federal Reserve System. So ACH, the automatic clearinghouse, which is like, the way our checks used to run, and now everything digitally runs from our bank accounts, is not real time. And so consequently, all these lags are still there. Those need to be eliminated. And check has been, or cash has been eroding, pretty consistently for decades. But what people don't realize is that the amount of cash in circulation is so high that even if it continues to erode at the rate that it has for the last 20, 30 years, it will be a prevalent form of payment for another 200 years.
I had no idea.
Nor I. And of course, that won't be a straight line, and it'll be an accelerating line and a punctuated line. But the point is more, like the bigger point is like we're going to have cash in our lives for much longer than most people presume.
So back to the infrastructure not being at a point where in this country, our infrastructure needs to get upgraded, I guess. Will you invest in sort of the more infrastructure-y things, and why not? Why can't we just copy other countries?
Yeah, great idea. And, the benefits of being in a competitive free market economy are that we're great innovators, and the disadvantages are that there are no autocrats who will mandate a single standard. And so the way banks are regulated is extremely complicated, and there's not one prudential regulator, there's 4. And so there's banks of every shape and flavor. And so then, it's just like an endless quagmire of political constituencies and bureaucracies that, other modern economies can have a government mandate to say, we're doing this now. That is less the case here. And what was the other part of the question?
Well, I'm just interested on that. So we have 4 regulators, is what you said.
Mm-hmm.
Do you think that do you think there's regulation that is potentially feasible that could really move the needle here by any of our current regulators?
So, the Federal Reserve Bank has had a real-time payments task force for the last 10 years. I've been on and off of it repeatedly, and nothing really has happened. We're still having the same conversations. I get this. I moved here from Holland, and I moved here in the 80s. That's a long time ago now. And in the 80s, I didn't even know what a check was. A paper check. We still have paper checks here. I'm writing paper checks to our gardener, for heaven's sake.
I'm sorry, it's not funny. It's yeah. Okay, and so with your core innovation hat on here, you're looking at these things, and are you sort of looking at where you think the future will go with your realistic core innovation hat on, and trying to back the entrepreneurs who are innovating on, on these, whether it's real-time payments or elimination of middlemen, I guess?
Yeah. We kind of have a technological view of this Martin Luther King quote I love, which is the arc of moral justice is long, but it ends, I forgot the end of it, but it ends positive somehow. And basically,
that's great.
The way I see things technically is very similar. right? I feel like technology and private markets, in long form um, are a march towards liberty and a march towards emancipation, and we're placing bets against both the world that we wish, right, the world that I want for my kids, and simultaneously we're placing bets, on where we think the puck is going.
What are some great examples?
Well, Ripple's a great example along the infrastructure side, right? Tens of millions of people move from poor countries to rich countries and send back every year tens of billions of dollars. And at a cost of somewhere between 10 and 20%, which is crazy when you think about it. The poorest people are paying such tolls, and they're working so hard and like leaving their, like all these crazy, and we certainly see this in spades in LA, right? Like there are so many immigrants. Something like half of Western Union's domestic revenue is made in Los Angeles County.
Whoa.
It's huge. So Ripple is basically just modernizing cross-currency settlement technology, right? Like if you want to move money from here to there today, probably Swift will be part of the story, whether you use it directly or whether Western Union or a third party uses it. And Swift technology was literally written when the Apple IIe came out, and we're still using that today, and it's moving $50 trillion per year today.
Right.
And it has a 600 basis point error rate because someone fat fingers a number, because there's a 10-digit number, and someone has to physically type that in when you're sending someone, $300 or $300 million, across the ocean.
Yeah. Okay. So, keep going.
So Ripple is building a modern tech stack that makes that real time and virtually free and secure, and addresses, a whole litany of issues that, have kind of gone by the wayside. They happen to use a cryptocurrency, right, which is kind of a sideshow, where the point is just it's a modern tech stack for making cross-currency settlement, as easy as sending an email is cross borders.
How did you decide that this was actually going to be, a startup disrupting this, multi-decade old industry? How did you decide that this would actually work and be worth betting on?
Well, as you know, right, at its dumbest, we basically look at team and TAM. And so this was an incredible team. Chris Larsen is a serial visionary who founded eLoan, and he called it right. He founded Prosper and called that right. And has always just been, and there's, in the scheme of things, not that many people who are right repeatedly. And so there was a formidable founder who is a force of nature, and that's an important part. And then there's a TAM, that's like $1 trillion TAM, right? Like the world spends $2 trillion on fees for getting money from A to B. But otherwise, honestly, when we invested in mid 13, we had no clue that any bank would ever buy them, let alone, be moving billions of dollars cross borders with them today. And we were willing to take a big bet very early. And I'm glad that we've done it. Although, there's plenty of examples where we did it and, I rue the day we did it.
Yeah. And so, right. So this is your third fund. You've been doing this for a while. Also, just, can you tell me the story of how you came to be doing this?
Sure. Yeah, very much by accident. So out of college, I fell into a startup. I hacked my way into our college grading system, and that got me a job at a startup down the hill in Portland, Oregon. And so I was developing educational software and had a real bee in my bonnet around, making education better by developing software. I went to the Media Lab at MIT, which your firm has a connection to, and a couple other education startups. And then someone gave me a book in 2002 about Mohammed Yunus and Grameen Bank and microlending, which was all completely new to me. And I read that cover to cover over a weekend, and I was like, holy moly, that is awesome. I love everything that it's about. And I was just blown away how this was basically a Bangladeshi man who was a US trained economist and who learned about free markets. And he went back and he devised a system of lending, which is economically empowering, which is incredibly efficient, right? Like these are loans to the poorest people on the planet of Earth, and they have 1% to 2% default rates, which is insane, right? Like Jamie Dimon would kill for that low of a default rate from a prime customer. So I was just like, whoa, this whole thing is so very cool. And so I was looking to start something like that in the US. I realized for a variety of reasons that microfinance isn't going to work in the US. And someone introduced me to a bunch of hippie bankers in the south side of Chicago who'd started a financial institution called Shore Bank in the 60s when, all the banks were getting a lot of shit for redlining, and they were, like not making loans where Black people lived. And these were a bunch of renegades who moved their bank into like the south side Black ghetto of Chicago and created a cottage industry around community economic development. And now there are hundreds of shore banks around the United States. And the other aha was, they were 50 years into their journey, and that whole cottage industry was serving 0.5% of the population. And so I was like, well, this is great, but it doesn't scale, right? Like half a century later, it's just barely scratching the surface. They're incredible place-based organizations. They're hyper-local. Mm-hmm. And so how do you solve the problem at a national level? And so a woman called Jennifer Tesher and I started a think tank, spun off from Shore Bank, called the Center for Financial Services Innovation, CFSI, now called the Financial Health Network, and started asking the question of how can technology basically create economic empowerment. And I started making small investments off the side of my desk, and one thing led to another. I was like, this will be my next startup. So
many questions there. Can I rewind and ask why microlending doesn't work in the US?
Yeah, totally. What makes microlending work is shame. And shame is a deep cultural phenomenon. And the reason that the default rates are so low is because there is relatively little migration in poor communities in developing countries. You kind of grow up in the same tribe, in the same place. And so every week you make your payment against your loan, and you get together with a handful of other people. And if someone doesn't have payment, then the other ones in the group have to pay for the person who couldn't pay. And the shame is so, like, it is just unconscionable to not make a payment. There's just no fucking way that you'll do it. And hence it's, so people scramble and just make it work because they don't want to live in shame with their neighbors. And for a variety of reasons, good, bad, and indifferent, and not all bad, we don't quite have that cultural construct here. And poor communities are much more migratory here.
Thank you to Strategic Law Partners for sponsoring this podcast. Strategic Law Partners was formed to provide the highest quality, common sense legal services at reasonable rates. Over its 25-year history in Los Angeles, Strategic Law Partners has represented many of the top local venture-backed companies, leading early-stage and late-stage investors, PE firms, and more. SLP Ventures has invested in over 75 companies, mostly in the Los Angeles area. Thank you to Brad and team. So you came from a think tank, and now Core, you're here in LA. Kat, who I know a little bit, she's in the Bay Area. and you're investing in the US, across the US.
Yep.
Fantastic. So let's go back to kind of what you're investing in. We talked some about infrastructure and fees. It seems like fees don't matter if I'm not making any money. I mean, not don't matter, but like, how do you think about helping people have jobs, keep jobs, have jobs that pay more money, that sort of aspect?
Yeah, that's a great question. It's something I've been much more mindful of lately. 10 years in, and we collect both our financial performance and we measure the externalities of our work. So what is our social impact? And our portfolio companies have in the aggregate created about $45 billion of savings for 25 million Americans. 80% of them are low moderate income. And that's starting to really add up, and I'm really excited about that. If our investors didn't care about a return, and thankfully all of them do, and thankfully all of them are happy, we would have an incredible social return on investment, right? If they were all foundations and they gave this to a charity, it's something like we've created $600 for every $1 that has been invested into core in terms of measurable value to an end consumer, which should be a wake-up call to philanthropy, which can hardly deliver this kind of ROI. But all that said, I'm cognizant of the fact that cheaper and better financial services are positive, but only mildly so. And what people, as you say, need much more than a cheaper alternative to a payday loan or a cheaper way to find an auto insurance or whatnot is they need more income, they need more steady income, and they need better protection from shocks. Because it's shocks that send people down these rat holes that they can never come back out of. So better, smarter insurance. And then on the income side, like we've looked for quite some time at small business finance, which is a big driver for income. We spend a lot of time looking in and around housing because for so many people, home ownership still is the main way to create some form of wealth. It's basically a forced savings regime that, across all of the positive and negative stories is net positive for most people.
And you're measuring your social impact. I just don't want to let that comment go away. I don't know a lot of VCs who measure their social impact.
Yeah, I don't either. More should.
More should.
Right? Like we're badgering our portfolio companies to measure everything, not just their financials, right? Right, like we're talking about OKRs and KPIs all day long, and what are the right ones, and what are our dashboards, and all this stuff. So we measure what we care about, right? And, like we have a bee in our bonnet about leaving the campsite a little bit better. And I feel like being in this asset class, so many people do, right? Like we're all doing this because we want the world to be a little bit better. How do we know we're doing well against that, right? Like we know how well we're doing or not financially. And for almost all of us, that's basically it. We've measured it for a decade now, and we've found lots of opportunities to do a better job, and to avoid this kind of business model and to seek out this kind of business model.
Do you have any specific recommendations?
Yeah, we basically measure three things: scale, quality, and alignment. And scale is like, are we reaching enough people? Right? Because to reach 5 people, not interesting. We want to reach the lion's share of the US population. That's the way you can make a dent. And then within scale is like, are we reaching the right people? Right? Like super wealthy people, they're fine. They're super wealthy. And then quality is like, are we advancing better quality products that are cheaper, that help in other ways, right? Like by using this, your credit score can go up, right? Like good performance can actually be net positive in other ways, or you're better protected in case of a shock, or, et cetera, et cetera. And then alignment is kind of the adventure that we're on, right? Like if we're right, we're not compromising returns in favor of social benefits. If we're right, then if we're investing in companies that create more value to consumers they'll be more valuable companies. And so we're just mathematically measuring the correlation between the financial performance of our companies and the social performance of our companies.
One of the things you said was it'll lead to improved credit scores or, things. Can you tell me some about where that's headed and how does data factor into the future?
Yeah, in so many exciting ways.
Great answer. Thanks.
We've had credit scores for a long time, and credit scores have basically taken very few inputs. Our performance on other credit instruments. Those are the traditional trade lines, and we're increasing non-traditional trade lines all the time. And it's a fairly laggy process. I invested in 2007 in a company called Rent Bureau that we sold for not that much to Experian that collected rental payment data so that you could report it and build a credit score. Only now, how many years later? 15 years later-ish, the FICO 9 score contemplates rental bureau data. But that's an accelerating curve of adoption in terms of non-traditional data. And then, and people use the credit score for more and more things, right? The permissible use for credit scores is expanding, not contracting. And that's just the official credit score, in the official credit bureaus. There's a whole litany of unofficial credit scores. And another interesting trend in data that I'm super excited about is, to date, FANG, the big tech companies, have largely monetized our data exhaust. And I'm excited for that to shift. And for us to be able to monetize more of our own data exhaust. To come back to an earlier question of how do you make up for people's income? Right, like since the 70s, how we're paid for our time has flattened while our productivity has gone up. So that's why people are basically, adjusted for inflation, as poor or rich as they were, 40 years ago, more or less. We need to find more and different ways by which to bolster our net income.
You wrote a great title. It was something like 1099 problems, but W-2 ain't one. It's pretty good because there's got to be a lot of different ways of bolstering, as you say, our income.
More people are making more of their income on Form 1099 versus Form W-2. So as a contractor versus an employee. And just as a secular matter, just for purely financially, that is to the consumer's disinterest. Because our whole social safety net, for however good or bad it is, I'm a European, so it's bad here, is conceived through Form W-2. Right? Our pre-tax benefits, our access to 401k and retirement, and health insurance, all this stuff is through a W-2 relationship, not a 1099 relationship. So that is a policy question. And I think the sad reality is what made America's middle class the richest middle class in the history of the planet was the labor union. And it was labor, who we love to hate today, who fought tooth and nail and who did ugly things in ugly ways and just pushed and pushed and pushed and pushed obscenely, in ways that is very distasteful to us modern people, but got, like a working class, a great income. And with labor mostly dead, and in many cases, I feel like rightfully so, right? I mean, so much meritocracy has been, upside down, but what will take its place? So we'll see. Meanwhile, we're writing checks against things that can just create financial efficiencies no matter where things go, but it is a real question.
Yeah. So I want to save time to ask you a couple other questions, but in terms of where you're writing checks, I think we kind of covered your point of view of the world. Anything else about Core to know?
I can't compete against the next guy or gal on finding a full stack developer. But where we can really help is like, your chief risk officer, your chief capital markets person, or, that kind of thing. That's easy for us. And then navigating all those relationships. How do you find a bank? How do you find an insurance carrier? How do you deal with the state regulators versus the OCC versus the FDIC versus the Fed? Blah, 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 all that stuff. We love that stuff.
It shows. That's great. Okay. First random question. If you could start a company, what would you start? What would it be solving?
I think I'd want to start a company that employed a lot of people and paid them a great living wage and built an ESOP in a world where ESOPs don't really exist. Right? In the startup world, everyone's in an ESOP, and that's kind of part of the ethos here. But that's not true in most of the economy, and with no pensions, the lion's share of people are just making their money on their hourly toil. And so I'd maybe start a light industrial company and make auto parts or plane parts or drone parts or something like that, and build a great ESOP so that people could really build intergenerational wealth as part of a normal working class gig.
Mm-hmm. So having equity in the company that they are building. I like that. Would you say, do you feel like you did a big career change in your life? Like I was talking with D.A. Wallach, who was on tour with Lady Gaga before becoming a biotech investor. I
love D.A.
Oh, he's amazing. But it was such a big career change. Do you feel like you did that?
Yes, very much so. I feel like I'm an accidental VC. I've always just followed my nose in my career. I've never made the move to the, learn a skill or, and use it later. I've just always followed my nose.
Right.
And realized that the best things that have come to me have been a function of serendipity and not volition.
I think this has been a great discussion. I don't think I have a lot of other questions. I know I told you I was going to ask you about how you evaluate founders, because I heard you say something great, which is actually negotiating the term sheet. A lot comes out.
Yeah, I always tell the team, I wish we could negotiate a term sheet before we negotiate a term sheet.
Right.
Because everyone's courting each other, right, before that point. We want to be the VC of choice. They want to be the entrepreneur of choice. And so it's all best foot forward, and everyone's courting each other, and it's all good, and it's typically way too fast, and you have no idea who the counterparty is, which, by the way, I think is a problematic phenomenon, right? We're engaging in 10-year relationships, literally 10 years plus, for successful outcomes. And forcing on both sides, forcing this into a 14-day decision process. Neither party knows who they're dealing with unless you do. For better or for worse, we did an analysis for our LP meeting the other month, to see how long we've known founders before we write a check. On average, it's 17 months. That isn't to say that you need to run a 17-month Series A process to get our dollars. I'm not saying that. But on the term sheet, instead of, you're not courting each other anymore, you're suddenly negotiating. And there is such a diversity of how we negotiate. And there is so much useful signal for making an investment decision in how a founder negotiates, right? Someone can be a product visionary, but not be able to strike a deal if their life depends on it. Mm-hmm. And you kind of have to do all kinds of deals in order to make a company work. And so, yeah, we found ourselves occasionally in situations where you're like, oh my gosh, we're really doing this? Yeah.
Well, Arjan, I'm not going to ask you any more about negotiating term sheets, although I could. Instead, I'll just say thank you so much for coming on the podcast. And I hope you can bring back the American dream. Really.
Well, it's going to take a bunch of us. So thanks, Minnie. I really enjoyed it. I so appreciate your happy curiosity and enthusiasm for your subjects.